Hello, this is John Kvale of JK Financial, and this is our October Capital Markets Financial Planning Review. And those of you that are not in listen-only mode that are also looking at this, you might notice a new camera. Number one son, now 14-year-old, is helping me with some new audio visual, and I've got this new microphone conspicuously, not inconspicuously, hung on my shirt here. It is a Halloween Sunday. And I'm going to move myself over to this corner here quickly, and we'll start the review, and hopefully the audio will be better and the video will be better as well. Both are mobile. Those of you longtime followers know that I end up doing these all over. I happen to be in the office. Again, it's Halloween morning on a Sunday, and it's kind of nice and quiet here in the office. Let's get down to business. So here we go. Ta-da! First, break-in. I did this as a break-in on the post. Those of you that are in listen-only mode, please keep your hands on the wheel. Stay safe. I always say that. Stay safe and drive carefully. Those that are in able to view mode or looking at the video, I'm going to try and keep this short. I've just got 3 or 4 main points. We were happily honored with the D Magazine's nomination for Best Wealth Managers. And I actually received my nomination for Best Financial Planner for the 15th consecutive year. Now, we have to be very careful for compliance. The regulators want us to make sure that just means that we're nominated. That doesn't mean we're the best. Now, we think we're the best, but we don't want to put it out there and say that we're better than everybody else. And I actually want to compliment all of those. I've got a lot of friends that also received the award. And so we're happy to be a part of a very honorable group. And we will move on. Those of you that are in listen-only mode, we're moving on to the first review of the financial planning tip, and it is the cell phone text. The cell phone text, those of you guys that I'm now putting the cursor over a FedEx text. Whatever you do, when you get these, I've gotten them from AT&T, I've gotten them from Federal Express, I've gotten them from credit card companies that we don't have. That's an easy giveaway. I've gotten them for the families getting tons of these. And don't click on it. If it's a real one, they're going to probably send you an email or call and leave a message. For heaven's sakes, don't answer a phone call that you don't recognize. And the trick that they do is whoever it is they'll just change 1 digit in the phone number. And then they also like to get phone numbers where the first 3 to 6 digits are exactly like yours and you think it's maybe a relative or friend. So this has become more and more prevalent. And I just wanted to, I did a post about it, but I wanted to reiterate it. We like to do, those of you that are newbies, we'd like to do basically a kind of a review, audio review of this, audio and, of course, a post of what I've done over the past month, because it gives a little bit of granularity on what we're talking about. All right, I've got a picture of Zell. He's the picture is actually a little bit big, so rather than cut it off, great podcast, Grant Williams podcast. It's a subscription podcast that I actually subscribe to, and I just find it fantastic. I reached out to Grant and said, hey, Grant, do you mind if I do a blog post on your Sam Zell interview? It was about an hour and a half long. And he said, not only sure, do it, but I'm going to share it. And he's got hundreds of thousands of followers. So the heat was on. I was like, oh, gosh, a little extra pressure on here. I wanted to pull, and those of you that are in listen-only mode, I put a link, and I have a link to this post, but I pulled out my 3 or 4 favorite things that he said in this hour and a half, and I highlighted it. In the post, I go through at length and multiple reviews after Grant said he's going to share it with my 3 big things that I thought Sam Zell was like. By the way, those of you that don't know Sam Zell, he's approaching 80 years old, maybe give or take 80 years old. He's most notably noted for his real estate progress, or his real estate investments, business, probably real estate first, then business, entrepreneur second, and of course, very much a person that donates a lot of his wealth now. The 3 neat things that I thought that I picked up from this were staying power is the name of the game. No surprises. He mentioned over and over that he had to live through some bad times. He didn't have years where he made money. Does that sound familiar? Investments, capital markets, but staying power, staying with it the long time. Real money is made by long-term holdings. Be patient. It's very similar. Those are two different things. Those are things that you guys hear us talk about all the time. And then another thing, and this is kind of one of my personal mantras as well, that one of the very last questions was, will you slow down? And he said, why would I slow down? I like what I do. And those of you that know me, you know that I prescribe to that as well. Good picture of Sam, and very, very candid, self-deprecating type of interview, and I just thought it was fantastic. Okay, those of you that are in listen-only mode, I've gone to a graph. Unfortunately, on this graph, the red line, which is representative of interest rates, didn't come out real good. I tried to redo it, and I had trouble with it, but basically, it's just showing the inverse, and I took an exaggerated example, the inverse correlation to as bonds go up, the value of bonds go down, and that's exacerbated the longer the bond is. So we generally keep shorter term bonds, and partially it's to in defense of a sudden spike will really hurt your portfolio, and also it is a function of you just don't get that much extra bang for your buck for going out for 30 years. We had to talk about this in 2018. As interest rates smartly went up, it took pressure on the bonds for the shorter period of time. We don't have long portfolios, nor do we at this time want long dated portfolios for this very reason. Rates are going up. The economy is finally looks to be reopening. And that's a bad news, good news thing. The bad news is a little bit of headwind on the valuation of our bonds. The good news is that we'll start clipping bigger coupons down the road. So it's just a reminder, the more conservative the portfolio, the more bonds you're going to have in your portfolio, and the more this will affect it. So it'll be a little bit more of a headwind. It's just pure logic. I do mention in the article that I have a link to that almost every portfolio needs some bonds in it because bonds are the stabilization factor of a portfolio. They don't move around. We're talking about small moves, by the way. We're not talking about huge moves as this headwind. And generally, when things get rough, which they will eventually again, bonds are the go-to safety net. So that's it. That's our October review. I hope the audio came out good, and I hope the video came out well. Those of you that are in listen-only mode, I'm scrolling back to the top of this. We generally, every year, do try and upgrade our systems. We did that over the summer with our email systems, and we try and do that here as well. So at the turn of the year, I will change the intro and some of the backgrounds, but I wanted to get a jump start on maybe getting a little bit better video. Hopefully it came out better, and get a little bit better audio. So hope you enjoy. Thank you. Talk to you at the end of November, which will be around Thanksgiving season. And we thank you very much. Have a great day. Bye-bye.